Hey everyone, welcome back for another deep dive. You know how we do it around here, digging deep into some fascinating topics to help you level up your game in business and life. And today we're going to be talking about strategy versus planning, and also touch upon some really interesting ideas about personal finance.
I think it's going to be a good one. I'm really excited to get into this because planning versus strategy, it's something that a lot of people, I think they get confused.
Yeah, they kind of use them interchangeably, like it's the same thing.
And they're definitely not.
Not at all. And I was watching
Yeah.
this video that really drove this point home, and it was saying, you know how we spend so much time planning our actions, but often what we're missing is a real strategy.
Yes, and that's the key difference, isn't it? A plan is like a to-do list. It tells you what to do, but a strategy goes deeper. It tells you how you're going to win, how you're going to actually achieve your goals in a specific environment.
Yeah, I love that distinction. It's like strategy is the roadmap that gets you to the destination. The plan is just like, okay, here are the steps.
Yeah.
But without the map, you're going to be lost.
Exactly. And, a perfect example of this that really stood out to me was Southwest Airlines. Their strategy was so simple but so effective. Become the better Greyhound bus company.
Okay, I remember that from the video too. It's brilliant when you think about it. They weren't trying to be like every other airline with fancy meals and all those extra frills. They focused on what really mattered to their target customer.
Affordability and convenience, and they did it by making some very strategic choices. They only used Boeing 737s for their entire fleet, which kept maintenance and training costs way down.
Oh yeah, that makes a lot of sense. And they flew point to point instead of the hub and spoke model. So less time on the ground, more time in the air, generating revenue. Plus, they were early adopters of online booking, cutting out the middleman and passing the savings on to customers.
And that commitment to their strategy led them to dominate the market. I mean, think about it. They became the airline with the most passenger seat miles flown in America.
That's incredible. It really shows the power of a well-defined strategy. And something else that stood out to me from that video was this concept of the angst of strategy.
Oh, yeah, that's a really important one because it highlights the discomfort that can come with committing to an unproven theory. It's like taking a leap of faith.
It can feel scary, right? Because you're putting yourself out there. You're betting on yourself and your vision, and there's always that chance that it might not work out.
But think about all the successful businesses and especially those disruptive startups that we admire. They all started with a bold, unproven theory. They were willing to embrace that angst and take a risk.
It's like stepping outside your comfort zone and into the unknown. And that's where the magic happens. It's where the real growth and innovation occur.
Absolutely, and that's something I want everyone listening to really think about. What's your playing field? What's your theory for winning? What makes you stand out from the competition?
Those are such good questions. And if you're finding this deep dive helpful so far, we'd love for you to hit that like button and share it with your network. Let's help each other level up our game.
Now let's switch gears a bit and talk about something equally important, managing your money. And I know personal finance can sometimes feel a little overwhelming, but trust me, it doesn't have to be.
Okay, I'm all ears because I think we can all use some tips on managing our money better, especially as we're building our businesses or leading our teams.
Well, there's this really cool framework I came across, and it's called the 15-65-20 rule. And it's all about allocating your income strategically. You dedicate 15% to savings and investments, 65% covers your essential expenses, and 20% is for pure enjoyment.
Okay, 15, 65, 20. Got it. So break that down for me a little.
Sure. So that 15% for savings and investments, that's all about building your safety net, making sure you're prepared for any unexpected bumps in the road. Like having that 3 to 6 month emergency fund gives you such peace of mind. You're not stressing about those surprise
Yeah,
expenses.
so it's like having that buffer so
Yeah.
you can breathe a little easier, knowing you've got yourself covered.
Exactly. And then the investments. That's where you really start to see the magic of compound interest happen. The earlier you start investing, even if it's with small amounts, the more time your money has to grow exponentially.
Yeah, it's like that snowball effect.
Yeah.
Right? It just keeps building and building over time.
Precisely. And you don't have to be a Wall Street whiz to get started either. I mean, maximize those contributions to your retirement plan, especially if your employer offers a matching program. That's free money you don't want to miss out on.
Absolutely. And there are other tax-advantaged accounts too, like Roth IRAs or ISAs. These can really give your savings a nice boost.
And when it comes to choosing investments, keep it simple. Passive index funds are a great option. They diversify your money across a whole bunch of companies, minimizing risk, and they have low fees. It's like a set it and forget it approach to building wealth.
I love that set it and forget it part
Yeah.
because let's be real, we're all busy.
Right.
So anything that simplifies things is a win in my book.
Agreed. Okay, so we've talked about that 15%. Now let's move on to the 65%, which is dedicated to your essential expenses. And this is where things can get a little tricky, especially for business owners.
I can see that. It's so easy to let those expenses creep up as your income grows.
Yeah.
You start thinking, oh, I can afford that bigger office space or that fancy new equipment.
Exactly. And while it's great to invest in your business, you have to be strategic about it. Every dollar you save on expenses is a dollar that can be invested in your future or put towards something else.
So it's all about finding that balance, right? Between investing in growth and keeping those expenses in check.
Precisely. Now let's talk about that 20% for enjoyment, because this is just as important as the other two categories.
Okay, because this is the fun part, right? It's
Yeah.
about enjoying the fruits of your labor and living a fulfilling life.
Absolutely.
Yeah,
It's about creating a balanced life that supports your well-being. And guess what? Enjoying yourself can actually make you more productive and less stressed.
100%. I've found that when I make time for things I enjoy outside of work, I'm actually more focused and motivated when I'm back at it. It's like recharging your batteries.
Exactly. So what's your version of that 20%? What truly recharges you?
Oh, man, that's a good question. For me, it's a mix of things. Spending time with my family, exploring new places, maybe catching a live concert, whatever it is that brings you joy, make space for it in your budget, guilt-free.
I love that. And that's the whole point of this rule. It's not about deprivation. It's about creating a life you love while still building that long-term security.
So it's about aligning your spending with your values,
Hmm.
right? Making sure that your money is working for you in a way that supports your overall well-being.
Exactly. And speaking of navigating the ups and downs, let's shift gears a bit and talk about the current economic climate. You know, the market's been a little shaky lately, and I know a lot of folks are feeling uncertain, so let's dive into that.
Okay, so let's talk about the elephant in the room. The stock market's been on a bit of a roller coaster ride lately, and a lot of folks are understandably feeling a little uneasy. We've been hearing a lot about a potential recession, interest rate cuts, tech stocks taking a hit, and even the Japanese yen making some unexpected moves.
Yeah, it's definitely a lot to process. So where do we even begin?
Well, let's start with those recession fears. There's this thing called the SAM rule, which basically says that when the average unemployment rate rises by a certain percentage over a specific period, it's a pretty strong indicator that a recession is on the horizon. And we have seen unemployment tick up a bit recently.
Right, but isn't it true that this time around the rise in unemployment might be because more people are actually entering the workforce rather than just massive job losses? So could that mean the SAM rule isn't as reliable an indicator in this particular case? That's a really good point. It's important to remember that no single indicator tells the whole story. You always have to look at the bigger picture. And unlike previous recessions, where those massive job losses were the main driver of unemployment this time, it seems like it's more about people feeling confident enough to start looking for work again, which could actually be a sign of a healthy economy.
Okay, so maybe not all doom and gloom then.
Sure.
What about those interest rate hikes? Because I remember watching a video where they were talking about how the Federal Reserve cutting interest rates has historically been a precursor to recessions, and now we're hearing chatter about potential rate cuts in the near future.
Yeah, that's another interesting wrinkle. But again, context is key. Remember, last year the Fed was aggressively raising rates to try and tame that crazy inflation we were seeing post-pandemic. Now that inflation is starting to cool down, it makes sense that they'd consider cutting rates to stimulate the economy and keep things moving in a positive direction.
It's all about striking that delicate balance, right?
Hmm.
Between controlling inflation and making sure the economy keeps humming along. What about those wild swings in the tech stocks?
Yeah, those have been pretty dramatic, haven't they? We've seen some of those high-flying tech giants take some pretty significant hits, and that's had a ripple effect across the entire market. Some experts are saying this is just a natural correction after a period of inflated valuations, especially in the AI sector. There was so much hype, and maybe some of those stock prices got a little ahead of themselves.
Kind of like that old saying, what goes up must come down, right? I also remember from that video, they were talking about some recent hiccups in the AI space that have spooked investors,
Hmm.
like those delayed releases of NVIDIA's AI chips due to some design flaws.
Exactly. And those delays have implications for other companies who are relying on those chips for their own AI ambitions. It's a good reminder that even with all the hype, technology doesn't always advance in a perfectly straight line. There are going to be bumps along the way.
Definitely. And then there's the curious case of the Japanese yen. This one honestly caught me a little off guard.
It's a fascinating example of how interconnected the global financial system really is. For years, traders have been borrowing yen at these super low interest rates and investing it elsewhere, profiting from the currency's depreciation and their investments' growth. But then the Bank of Japan decides to raise interest rates, which causes the yen to appreciate in value, and suddenly all those strategies get thrown out the window.
So it's a reminder that events happening on the other side of the world can have a very real impact on our own portfolios, right?
Absolutely. So given all of this, what are some actionable takeaways for our listeners? How can they navigate this kind of turbulent market and make smart decisions for their businesses and investments?
Yeah, that's the million-dollar question.
Well, first and foremost, don't panic. Market corrections are a normal part of the economic cycle. They might feel scary, but they also often create opportunities for savvy investors. Remember that old saying, buy when there's blood in the water? Market downturns can be a chance to buy quality assets at a discount. But, and this is crucial, only if you have that solid emergency fund in place. You don't want to be forced to sell at a loss when the market rebounds.
That's such good advice. And what about dollar cost averaging? Isn't that a good strategy for dealing with market volatility?
Absolutely. Dollar cost averaging is a fantastic way to navigate those ups and downs. It basically means you invest a fixed amount at regular intervals, regardless of what the market is doing. That way you're buying more shares when prices are low and fewer shares when prices are high, which helps smooth out your returns over time. It's a really disciplined approach that takes the emotion out of investing.
Love it. And I can't emphasize enough the importance of diversification. Spread those investments across different asset classes, stocks, bonds, real estate, you name it, to reduce your overall risk. Don't put all your eggs in one basket, as the saying goes.
Yeah. Exactly. And staying informed is key. Keep an eye on those economic indicators. Really try to understand the forces at play and be willing to adapt your strategies as needed.
It all comes back to strategic thinking, right?
Yeah.
Just like businesses need to be agile and adapt to those changing market conditions, so do individuals. We've covered a lot of ground in this deep dive, from the power of strategic thinking to smart money management and navigating this crazy economic landscape. If you had to sum it all up, what's the one key takeaway you'd want our listeners to walk away with?
I'd say it's this. Knowledge is power, but only when it's put into action. Take these insights, apply them to your own life, and watch as you achieve some pretty incredible results.
I love that. It's not just about passively absorbing information. It's about actively using it to make smart decisions and shape your own future. That's what this deep dive is all about, empowering you with the knowledge and strategies you need to thrive. And that wraps up another deep dive. Huge thanks to my guests for sharing their expertise, and to all of you for tuning in. If you enjoyed this episode, please hit that like button and share it with your network. Let's help each other succeed. We'll see you in the next deep dive.